Does Peter Schiff sleep in a bed made of gold bricks? Can gold save you from zombie apocalypse? Strap in as we uncover why Peter Schiff thinks buying gold right now is the ultimate solution to all your problems. Stay tuned because today's video might just turn you into the next gold mogul, or, at the very least, leave you questioning your existence in a world without bullion. Let's dive in, shall we? Is gold's best day behind it now that it hits a record high price? This is the question in many investors' mind after gold recently reached an intraday all-time high at $2,135 per ounce, only to fall sharply soon after by over $100. Has gold peaked, or does it still have a room to rise to new highs? While some view gold's pullback from the recent peak as a sign of a bubble bursting, several factors suggest that rally likely still has legs. First, the intraday record came amidst rising geopolitical tensions around Iran, indicating that gold remains sensitive to uncertainties that prompt safe haven demand. If such global tension persists or deeper, investors are likely to keep piling into gold, pushing prices higher. Additionally, unlike past temporary gold spikes driven by speculative manias like the Hunt brothers' attempted cornering of the silver market in 1980s, gold's multi-year ascent has been relatively steady since finding a bottom in late 2015. Gold has carved out a series of higher lows on the charts. It finally broke out of a 6-year base in June 2019 by piercing heavily technical resistance at the $1,350 level. This shift from range-bound to rising price action reflects genuine, sustained investor demand driven by dovish central bank policies and worries over excessive money printing. Rather than the last euro climax, gold taking out key resistance around $2,000 likely signaled a new bull run is just getting underway. Considering gold spent years trying to surmount $2,000, this breakthrough suggests the selling pressure that kept a lid on prices has exhausted itself. Now, having cleared a path to the new highs, gold enjoys room to run. Could Bitcoin siphon away some demands from gold in the future? Bitcoin has grabbed its share of headlines for sharp rallies, including recently topping $42,000 on speculations at the US Bitcoin ETF approval is drawing near. If crypto comes to be widely regarded as digital gold and cements itself as a leading alternative asset, could this redirect some investors' funds away from gold in the years ahead? It's doubtful Bitcoin could meaningfully detract attention from gold anytime soon. One reason is demographics. Those interested in speculative crypto investing tend to be younger compared to more conservative gold buyers. Further, Bitcoin exhibits extreme volatility versus gold stability, making crypto less reliable for wealth preservation. Gold also enjoys a multi-millennia history as trusted money, an unmatched pedigree that Bitcoin lacks. These factors suggest gold and Bitcoin satisfy very different investors' motivations, allowing both markets to flourish concurrently without detracting from one another. In fact, the stunning Bitcoin rally highlights why gold remains under-owned and attractively valued relative to other assets. Considering gold's proven ability to hold purchasing power over time, it offers one of the best avenues for prudent investors to diversify away from riskier holdings like stocks, bonds, and cryptocurrencies. This should keep funds steadily rotating into gold from traditional portfolios rather than exiting gold for crypto. How does gold compare to Bitcoin specifically as an inflation hedge? A key rationale for prudent investors owning gold is its role as an inflation hedge and store of value. But how does it stack up versus Bitcoin on specific function given today's soaring inflation? Over the past 50 years, gold has clearly proven itself as an effective inflation hedge, retaining its purchasing power much better than fiat currency. Meanwhile, Bitcoin's track record as an inflation hedge is unproven and too short-term oriented given its newness. This makes crypto far less reliable than gold for wealth preservation and amid rising prices. Bitcoin also suffers from extreme volatility, with swing of more or less 20% in a short time span not unusual. This unstable price action determines Bitcoin's reliability as store of value. Bitcoin is also frequently on the news due to hacked accounts, stolen funds, or investors losing access to their holdings. Such as counterparty risks don't exist with physical gold held in one's possessions. Of the two competing assets, gold clearly remains a superior inflation hedge and wealth preserver based on its track record and role as money for millennia across human civilizations. Crypto may still appreciate speculatively, but lacks gold history for maintaining its purchasing power over time. Will approval of a Bitcoin ETF divert investors' funds away from gold? Bitcoin has been on a tear recently, rising above $42,000 amid speculations that regulatory approval of a US Bitcoin ETF is drawing closer. The crypto community predicts massive investors' inflows towards Bitcoin once it gets easier to gain exposure through an ETF structure. Could the launch of a high-profile Bitcoin ETF therefore undermine gold by directing investors' interest? While intuitively a concern, it is unlikely a spot Bitcoin ETF would meaningfully drain interest away from gold. One reason is there are already ample ways for investors to purchase Bitcoin, minimizing pent-up ETF demand. Retail investors can easily buy actual Bitcoin, gain exposure through crypto proxy stocks, or access foreign Bitcoin ETFs. Institutions like family offers directly custody Bitcoin. An ETF may be more convenient but doesn't solve an unmet need. Additionally, gold and Bitcoin appeal to very different investor psychologies. conservative wealth preservers versus risk-tolerant speculators. Hence, fund flows are not necessarily interchangeable between the two. Gold offers stability, Bitcoin offers explosive upside. These distinct value propositions allows both markets to thrive simultaneously without detracting from one another. Rather than weaken gold's appeal, Bitcoin's emergence to prominence underscore why gold remains underowned among prudent investors. By further raising awareness about alternative to fiat money, Bitcoin validates gold's role as the ultimate store of value of those focused on stability and inflation protection. Expect conservative funds to continue flowing into gold from traditional asset allocation rather than exit gold for crypto. Could gold plateau for an extended period and lose its appeal after this run? Some investors worry whether gold might plateau for years at current levels, which could diminish its appeal after such a strong run. However, this seems unlikely given deeply negative real interest rates, ballooning public debts, and other supportive monetary tailwinds still blowing strongly in gold's direction. Consider gold rocketed higher in 1979 to 80, and interest rate eventually peaked around 15% in 1981. Yet, despite rates remaining elevated throughout the 1980s, gold never durably traded back below the $300 an ounce handle. Flash forward 40 plus years, and today's macro backdrop remains extraordinarily bullish relative to the 1980s. US real interest rates sit firmly in negative territory with roughly $30 trillion added to America's national debt over just the past 2 years. With still rising entitlement burdens, spending demands, and political pressure discouraging fiscal prudence, an eventual financial reckoning seems inevitable. All this bodes for a prolonged period where out-of-control public debt can be tamed through an inflationary devaluation of the currency. Essentially, the current policy trajectory points towards considerably more weakness in fiat money, an ideal scenario for alternative hard assets like gold to shine as a hedge for years still to come. What level could gold ultimately reach before this bull run ends? It remains difficult to precisely forecast a peak price, but it's reasonable for gold to double to $4,000 based in history and the current global macro picture. Adjusting for US inflation to 1980's peak of $800 an ounce, gold today would need to reach about $2,500 just to match the last cycle's records. Yet, compared to all financial and hard assets, gold remains far from an obvious bubble. Looking farther back in history, in 1934, the Gold Reserve Act valued the gold at $35 an ounce. By 1980, when interest rates finally broke gold's rise, its nominal price has climbed nearly 24 times in 45 years. A similar growth trajectory today, if sustained for 4 more decades thanks to persistent currency debasement, could possibly lift gold to $4,000 an ounce by 2065. And measured in today's dollars adjust higher for inflation, the real 2065 purchasing power equivalent might reasonably approach $6,000 to $8,000. While these figures may appear extreme, recall that in financial crises and monetary resets, gold can gain tremendously within short periods as confidence is lost in a weakening currency. And that, my dear gold enthusiast, is how Peter Schiff flips the script on our financial worldview. If you're still not convinced that your future lies in a vault of gold, smash that like button and let us know you're ready to take the plunge into glittering prosperity. Don't forget to subscribe and hit the notification bell because, who knows, maybe our next video will feature Peter Schiff explaining how to turn your kitchen into gold.